Welcome back. Asian markets are somewhat sulking after the announcement of the final tariffs for most nations. India, which has suffered a worse shock of 25% after hopes of around 15% tariff, is actually holding up in terms of at least stock market performance, especially in the last half hour. There are still many moving pieces. The rate on China is still under negotiation. India faces a threat of possible additional penalties sometime soon. But some of the dust has settled. So how are the current rates likely to impact global growth, Asian growth, and hence India's growth? I have with me Chetan Ahya, the chief Asia Economist at Morgan Stanley. Good morning, Chetan. Thank you very much for joining me on what must be a busy morning for you. What are you all marking down, either global growth or Asian growth, after we now know the final tariff numbers?
Well, not really, Latha. I think we were all expecting that tariff numbers will be high. The last round that we had seen was a minimum of 15% for most of the large Asian economies, and then some of them had 19 and 20. So in that context, the development overnight is not really a big news that we need to change our numbers. Remember that in India's context, we have always mentioned that the framework to look at would be to see who is more exposed to global trade, i.e. goods trade. And we therefore had India getting impacted the least across the region. And that framework still is intact pretty much, Latha. So it's not the direct effect of tariff as much as the indirect effect. And the indirect effect is basically that global Capex and global trade would slow. And in that context, India is sort of least exposed, and that remains the case.
Okay, fair point. India is least exposed. It's only 2% of our GDP that is comprised of exports to the United States. That point is taken. But y'all must have penciled in a 15% kind of tariff. We are now hit with 25 and possibly more. Let's wait and see if we are able to negotiate our way out of that. So because of this 25, are you all giving a downward bias? What is your GDP number, and is there a downward bias?
So our GDP number is, it's on for the full year. We are at full year calendar year 2025, we are at 6.4. And we had built a slowdown in growth on account of the expectation that tariffs would be lifted up across the world. And as I mentioned, we have built a lot more out of global trade downside, and that affects India's overall trade, not just exports to the US, but overall trade would slow because there is a slowdown in global economy and global trade that is coming up upon us. And with that, we built quarterly GDP growth in India slowing to 5.9% in the fourth quarter, and that would have been the worst in terms of the downside impact. Now, clearly, if there is, this 25% number that has been announced for India, if it stays for longer, our current expectation is that there will eventually be negotiation between the two countries, and the tariff rates will come down. But let's say assume that this tariff number stays, and we have additional tariff on account of Russian crude purchases, then there is definitely some downside risk that we have to consider. And just one other thing I wanted to highlight, you mentioned India's exports exposure to the US is 2% of GDP. That's actually 1.4. If you take out the stuff which is exempted, this electronics is exempted, as you know, that's a big line item from us to the US now, and it's probably going to get bigger with iPhone exports. That bit is exempted. So that is 1.4% of GDP. So that's even smaller. But as I would just want to keep reminding that the bigger story that we have to worry about is the global trade slowdown and downside from that, less about the direct effect of tariffs on India.
No, I take your point. There is the larger one, but the market is worried about current EPS and next quarter's EPS. And there you have to, write in the tariffs for textiles. Incidentally, it's also pharmaceuticals that have escape the tariff for now, which is also somewhat of a line item in India, electronics being the bigger one. But Chetan, what about the subsequent years? Morgan Stanley was pretty bullish that India is going to have, up till 2030, probably a 6.7, closer to 7%, 6.5% to 7% kind of growth. Do you think that with this tariff uncertainty and the China plus one story, therefore, kind of losing its sheen, will we have to, look for downside risks down the line as well?
That's unlikely, Latha, because I think we're sort of building in this downside on account of tariff to be there for the next 12 to 18 months from a global standpoint, and therefore that would sort of weigh in on India's numbers as well. But beyond that, we think that we will sort of still be looking at the India story, which is to be decided by the Indian policymakers. I think there is a lot more that the control in terms of India's growth outlook is very much with the Indian government. Unless we're expecting that there will be a significant global trade slowdown persisting for the next 3-4 years, this should not be an issue that kind of affects the medium-term growth story for India.
Okay, what are you expecting in terms of inflation? Will there be further disinflation because you're not exporting much to the United States? And therefore, India, what is your India number and what is your expectation from the Reserve Bank?
So right now, we're expecting inflation to be in the range of 4.5%. But we are getting, and if you look at the core inflation numbers, they're pretty much in line with that. The downside risks are still there. One is because monsoons have been great, and so food prices may remain low. And at the same time, we still continue to see this disinflationary pressures emerging from China. Also on account of the fact that there is a global trade slowdown that is upon us, that will also have further additional disinflationary pressures on India from the external side. So we think that the risks are that you probably would see inflation surprising on the downside.
Okay, and therefore rate cuts more. Therefore, you're expecting rate cuts.
Yes, yeah, we are. Sorry, I missed your question. So yeah, I think we are expecting one more rate cut in October. And if there is more downside risk materializing to inflation, then we'll probably see additional rate cuts.
Okay.
I think it's already kind of quite weak. If you look at core WPI, I would say look at manufactured products inflation. That's running at around 2%. And it's been running between 1% to 2% for a while. And so, yeah, I think the risks are to the downside on inflation, and therefore there is a chance that RBI actually does more rate cuts than what we have in our base case.
Okay. Chetan, we have some breaking news coming in, and therefore I have to run into a break. Just a final word on when do you all see US inflation coming up and therefore your Fed rate trajectory?
So for the US, we are building in core PCE inflation, which printed yesterday at 2.8%. We expect that to go to 3.2% by the year end. And therefore, our US economics team is actually not building in any rate cuts for this calendar year. They have it only in the first quarter of next year. Of course, it depends upon the labor data that we get today in the evening. But to the extent to which we are not expecting a very sharp deterioration in the labor market, and we see that inflation is going up to 3.2%, we think that Fed's hands would be tied in terms of rate cuts this year.
Okay. I'm sorry, I'll have to wind this up a little faster than I thought. We have some breaking news coming in. Chetan Ahya, thank you very much indeed for sparing time for us this morning. It's a quick break, but we are back in a jiffy, and there's some big breaking news awaiting you.